Hey traders, Nick Shaheen here looking at what happened on 8/14. This is the day when the stock market fell about 3% right here. Big red candle after big green candle after big red candle after big green candle. So bottom line is the stock market is ping-ponging just around the point of control for the whole year. This is where bulls and bears have fought it the hardest. Yes, this is the accident scene from the last October. So we recovered it, exceeded it. We should have held it, but we didn't, but we're still in the same zone. This whole thing is normal price action, levels wise, but it's the violence, the sizes of the candles don't make sense. So the price action from the level perspective is normal, but the candles are not normal because of headlines. Okay, before I forget, there should be somewhere popping up either now or at the end or both to subscribe to the YouTube channel. It's free. You can hit it. I do publish videos often. So back to the point. So what happened today? First, we had the other red, I forget what was a tweet, something about China, but then the currency, China pegging the currency this way. I said, mark my words, as soon as we're done with the Hong Kong fires in the streets and all of that, then CNBC is going to cover this next chart. And I said, I have only two worries, yen levels and this chart right here. What is this? This is the yield curve. What is that? That's the point of this video today. What is it and how we could have seen this coming? Well, when I warned, it was here. And then I said, if this doesn't reverse and it was falling, we're going to wake up to a freak out, a big down day because of it. So just hindsight, I mean, a little more on that. A few weeks ago, if not months, I remember also posting a video saying, hey, CNBC just pulled the fast one because we woke up. The yield curve has inverted. That hasn't happened since whatever, X years they mentioned. Well, here we are. That hasn't happened since 2007. That's because I called bull on them last time because they said it and they have switched to watching the different yield curve. We have all kinds of yield curves. The one we're talking about today is 10s to 2s. The one they talked about back then, I think, was 10s to 3 months or something like that, or 3 years to 3 months. So they changed, but they always mean this when they say yield curve. For as long as I've watched CNBC, every time they say 10, if you hear Centella in your head, the yield curve, the 10s to 2s, that's what they mean. And that back then, I can't remember what red candle it was in the market, but they came out and said the yield curve had inverted. That was the headline one morning, weeks and months ago. And today's headline, the yield curve had inverted. It hasn't happened since 2007. Like, wait a minute, that can't be. That's because they're pulling a fast one on us again. All right, so let's explain what the yield curve, in plain simple English. I am not a Wall Street guy. This is not a recommendation to buy or sell stocks. This is me explaining in plain simple English what the heck that means and why does it always foretell a recession. By the way, they say that economists, forecast, always forecast the recessions incorrectly, basically. Everybody claims that this is what happens, yet it doesn't happen all the time. It's not even a 50-50 coin flip. So now back to what it means. When banks lend, they borrow at short-term rates and lend to us, the consumers and the companies, at higher, longer-term rates. So they borrow short-term, it should be cheap. They lend at higher, longer term, which should be expensive, the rate. So they make money on the spread, right? That's how we all know. When you used to go out and book a CD and say, hey, let's put 10,000 in the CD. How long you want to lock it? 10 years, I'll give you a higher rate. 1 year, I'll give you a lower rate. Well, the inversion means it's backwards. The longer you book it for, they're going to give you a lower rate than booking it for 1 year. It doesn't make sense, right? And that's what's going on here. Look at the value. It's 0.996 right now. So the 10-year is smaller than the denominator, which is a 2-year. So basically, it's below par. It's inverted. It should be the other way around. It's not the trend of this line. It's the actual value of and what it says about the rates. So what does that mean? In my opinion, this is the market forcing the Fed's hand, because he said last time he lowered rates a quarter, markets were okay. They reacted positively. They were fine until he opened his mouth. That's Jerome Powell. He said something along the lines, this is not a change in cycle, meaning I'm still in he said it's a mid-cycle adjustment. So that kind of insinuates that he's still in a raising cycle, a hike cycle, but a mid-cycle adjustment lower in order as insurance. That freaked us out and the market fell out of bed. So this time around, he's going to have to cut. And will he say that? If he doesn't, then it may tell the markets, hey, wait a minute, whatever he said last time was a brain fart, just like what he said last November or December, whenever it was, when he caused the tizzy in the market to go to the all-time lows then. Not all-time lows, last year's lows. So we are still pretty high. These are the markets. Let me hide all the lines. This is all-time high. This is the market now. That's not too far from it, 5-6% tops. Okay, so this was an abomination because the Fed was hiking and China was going on. This time, it's not the same. So the question is, will we, number one, hit the 28.22, which was a clear bounce level, and or will we hit the 27.80-ish, or will we go down to the May lows, May, June, the lows here? And if those don't hold, then is this some sort of a megaphone expanding pattern, blah, 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 that will target the lows of the questions will be, are we going to here? Gut says no, because this was an abomination and the Fed is on our side this time. Well, we thought it was, but the market will force his hand, in my opinion. So back to the point. Why does the inverted yield curve cause a recession? If the banks are not going to lend because it's expensive for them to do so and it's a losing proposition, then the companies don't expand. So company ABC won't, build that plant, buy the tractor, hire somebody. And even though we have full employment, I can't buy a house because the bank doesn't want to lend me the money, because they lose money. Because if they borrow at higher rates than they can lend at, they're not going to do it. That's the bottom line idea. So what can the Fed do? What can the government do? Well, so far we've talked nothing but monetary stuff. What does that mean? The Fed doesn't control fiscal spending. It can't say go out and build a bridge. The government has to do that, and the politicians. And unfortunately, we have lame duck sessions, so we're split. The House and the Senate. So nothing is going to get done. So fiscal spending is probably impossible unless we have like a crisis. So if Trump is going to propose, if the Republicans are going to propose, hey, let's go out and build some railroads, or let's expand a hyperloop throughout all of California, or into I'm just ridiculously saying stuff here, but you get the point. Monetary, the Fed can do that, but there will need to be some fiscal spending. So what can the Fed do? The Fed can cut rates aggressively. They can say 2 points. And hey, guess what? We're done raising forever. Or here's 3 points. We've seen, this help. Or they can restart QE. They stopped QT, which is selling bonds. They can start buying. So what does that mean? It means they're putting money into the system and taking bonds off the market, basically. So people will have money to do other stuff with that. The stuff, the money they're getting from the Fed. That's the silly way of saying things, but. And then they can do some, what is it called, LTRO. Go call Draghi, he'll tell you what the heck that is. Long-term repo, reverse repo, whatever. Basically, they kind of artificially flip and make it, flip the rates and make it okay for banks to borrow it, even though the actual rates are lower. So my Main Street look at what the heck happened and what the heck does the yield inversion is. So this is more of an audio on the yield curve than the actual what's going on as far as trading. The point is to clarify what's going on, not to actually say what's going on with the trading idea. My sentiment on trading, so if I own Apple, then I'd want to know, what does that mean to Apple? Doesn't mean much. So Apple itself is a great company. It has its own money. Yeah, they do sell bonds. They're in debt now thanks to Tim Cook, so their cash position is less ideal, but it's still bulletproof. And how many fewer iPhones are they going to sell, or how many fewer subscriptions are they going to sell, which is more important now because the iPhone is no longer as important as before. Okay, so what about Google? Same comments. This is a cash cow company. Very little with regards to the yield curve is going to affect it. Facebook, technically it's not ideal. It's looking like an inverse cup and handle. Maybe it hits the point of control, which I can't read this orange line, 165, 170. Not calling for it, but if it does go there, I'm going long. This was an emphatic bounce. Still a gap down here. Okay, so what don't I catch? Cisco, for example, gave us a reason not to catch it. And this candle is way too big. They guided lower. And so I'm going to lose some money on the calls, but they were lottery tickets. But I would wait a couple of candles and then maybe decide to see if I wanted to go long it. This is a point of contention where it's at right now, so chances are they'll fight over it a little bit, so I'm not running to catch it. What else? Disney, great company, great rally, but whoa, still a lot of froth to go. Roku, same deal. I was short Roku. I closed it today. Maybe I should have reopened it tomorrow. Maybe. I don't know. Big gap down here. So I'm not calling for lower prices, but I'm saying I don't try to catch falling knives that have so much froth in them. The mother of all froth is usually Amazon. Almost identical chart to Facebook, so exactly the same comments there. Boy, this video is turning into something else completely. All right, so I'm going to stop right here. You get the idea. I don't panic out of stocks because of the inversion of the yield curve blindly. I do buy protection wherever I need it. I don't like to buy VIX calls because I never got them to work for me. I don't like to buy VXX calls either. I like to defend directly. So if I'm long Facebook, I'll buy Facebook puts. If I'm long a whole bunch of SPY companies, I'll buy SPY puts or SPS puts. I sell some call spreads maybe against it if I know how to do options better. So there's plenty of I can do. I don't like to buy stuff when it's as expensive as it's been in a while. What does that mean? The VIX is so high. So everything I buy single legs is expensive. So if I buy anything, I'll buy a spread. Why? Because it kind of neutralizes the high VIX. Depends on where I buy it. So then I'm not buying premium, puts at a premium. So down market makes put premiums go up. High VIX makes that even worse. So food for thought. Nick signing out. You know where to reach me.